What if you could get your weekly paycheck without getting taxed at all? How much more money would you have? How would you feel? Amazing, right? That's basically what tax advantage accounts can do for you. At the end of the day, it's not what you make that matters, but what you keep. If you make 100K selling cabbages, but pay 50% in taxes and fees, how much did you really make? 50K. The basic idea here is to reduce taxes and fees so you can have more money. David Swensen, the Chief Investment Officer at Yale University, says there are three factors to make the most money in investing: asset allocation, diversification, and tax efficiency. We will talk about tax efficiency here, and one of the best ways to become tax efficient is to use tax advantage accounts. Tax advantage accounts are basically accounts that let you pay less taxes. The reasoning behind these accounts is to give you an incentive to save for important life expenses like retirement, education, and healthcare. If you invest with regular accounts or a typical brokerage accounts such as Robinhood or Webull, the government will tax you annually on any money that you earn, such as interest or profit from selling. This gets really expensive if you invest in any actively traded funds. These funds buy and sell stocks regularly, so you will see a nice tax bill at the end of the year even though you didn't sell your fund. However, if you invest through a tax advantage account, your gains won't be taxed every year, so you will save hundreds of thousands of dollars on taxes. There are three main types of taxes you need to know. 1. Ordinary income tax. Anytime you make money from your job or other places, you will have to pay this tax. The rate is 10 to 37% depending on your income. 2. Short-term capital gains tax. Anytime you sell something that you own for less than a year, you will have to pay this tax. The rates are usually the same as ordinary income tax. 3. Long-term capital gains tax. Anytime you sell something that you own for more than a year, you will have to pay this tax. The rates are 0%, 15%, and 20%, depending on your income. If you're enjoying this video so far, make sure to hit that like and subscribe button. To avoid these taxes, you can use different accounts. Which account you use will depend what you need the money for: retirement, education, or healthcare. If you need money for healthcare, you can use a health savings account, HSA. A HSA lowers your taxable income for this current year. If you make 100K and you put 5K into the HSA, you will only pay taxes on 95K this year. In addition, you can withdraw money tax-free for any health-related expenses. If you need money for education, you can look into the 529 plan. The government won't tax any money you take out for higher education. Contributions, or the money that you put in, are usually after tax, but can still offer some tax deductions. Lastly, and most importantly, there are the famous retirement plans, 401ks and IRAs. You can pick between the Roth version and the traditional versions. If you want to save on taxes now and pay taxes in the future, go with the traditional versions. If you want to pay taxes now and not pay in the future, go with the Roth versions. Regardless of which accounts you choose, you have to be careful of two major things: fees and selection. Your fees include account maintenance fees, transaction fees, advisor fees, mutual fund fees, and so on. The selection is the list of investments that these accounts offer. The last thing you want is to pay for an expensive product that fails to make you money. In the investing world, a high price does not mean it is high quality. If you're paying more than 1% overall, you're probably getting ripped off. Paying too much investment fees and account fees is like filling a bucket with holes in it. You will never get to your financial goals. If you want to know whether you're getting ripped off or not, this next video will help you find out what fees you're actually paying on your investments.